Welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source. Today is the first of 3 videos that we're going to share with our clients on what we expect to see in the markets in 2022. Joining me today is Eric Clapsaddle, our Senior Fixed Income Portfolio Manager. Eric, 2 of the topics that come up most with clients are the U.S. labor markets and then the U.S. consumer. When we think about the U.S. labor market, there's about 4 million people less working today than there was pre-pandemic. Yet the economy is actually bigger. How should we think about the U.S. labor markets as we go into 2022 and how that might impact companies and investors?
Labor markets are going to be the preeminent issue in 2022, even more than inflation. It's going to be a challenging year based on the data that we see for employers. They're going to have to find staff and maintain staff. And all the data shows that it's going to be a challenging year. As you can see on the chart, employment levels pre-pandemic are still higher than where we are today, but we continue to inch closer and closer to that high. On top of that, job openings in the US today hover around 10.5 million, but we only have about 7.5 million people that are actually unemployed. For companies, this means that they're going to have to pay higher wages, which they have already started doing. Specifically in the service industry. If you look at the leisure industry, which is a subset of the service industry, wages for the past 12 months there have increased by 12.1%, and they've only increased by 4.6% in the overall economy. Investors are going to want to see that companies, through this, can continue to grow revenues, maintain their margins, and continue to be efficient. Something that we believe companies can do as wages moderate, continue to stay probably higher than normals, but wages moderate and inflation moderates.
So part of what's creating all this economic activity and the need to hire so many people has been a relatively strong consumer in the middle of a pandemic, which is counterintuitive. How should we think about the consumer as we enter the new year?
So the consumer today is in very good financial position. And that is despite some recent data showing that consumer confidence has really declined. There's some variables that have affected that in the very short term. Actually declined to the lowest level since November 2011. But the overriding factors and the things that we really like to go to are the liquidity of the consumer right now and the labor markets. One, and you can see on the chart that total demand deposits in the United States, demand deposits being money that is accessible right away at a bank, are at $4.87 trillion. Pre-pandemic, they're at $1.47 trillion. And secondly, on the labor side of things, as I already stated, job openings in the US today are at about 10.5 million, and there's only about 7.5 million unemployed people.
So the consumer is in pretty good shape. But part of the impact of having this consumer in such good shape is there's been an unbelievable surge in the demand for goods in particular, and this has created inflation. And that's only been compounded by the supply chain disruptions that we've seen, particularly here in the United States. So how does inflation and the supply chain disruptions potentially impact decisions the Federal Reserve will make in the upcoming months and year?
Well, Jerome Powell, Federal Chairperson, recently stated, November 30th, this past Tuesday, that the Fed was going to start talking about reducing their bond purchases, which has been a tool to keep interest rates low. Talk about doing it before the end of their current timetable, June 2022. So it would be sometime before that, which means the Fed could also raise rates sooner than they expected. And why? It's because the Fed now sees that inflation is a more serious issue, more serious thing they need to manage than what they've previously been thinking. A place that we have been for a while, actually. And what we've done different for our clients is we have shortened up maturities within their bond portfolios because 1, the economy's strong, 2, inflation's rising, and we think with that, interest rates will slowly increase.
Well, Eric, as usual, I appreciate your insights. We've covered the U.S. labor markets, U.S. consumer, Federal Reserve, kind of our strategy currently on the fixed income portfolio. So thank you very much for that. I ask all of you watching to keep an eye out for your email in the coming week, where we'll send out our second video on the 2022 market share outlook. You'll hear from Rob Romano, our Director of Research, and what we expect to see in equities in the coming year. As always, thank you for the opportunity to work with you and your family, and have a great day.